Welcome, welcome, welcome. We are live. Today is Friday, July 1st, 4th of July weekend. I'm apparently in some undisclosed bunker on the East Coast right now, trying to prepare for these weekend festivities. Corey's at his usual spot where he just bangs his head on the doorways in his little hobbit hovel. And once again, he's Corey Hoffstein. I'm Jason Buck. Working the ones and twos is Captain Jack. Once again, whatever we say is definitely not investment advice on this Friday. Please, search out your own financial advisor and do your own due diligence. So with that, you're going to get two guys rambling, talking about a variety of topics. Even though I think I might even come up with the topics this week, I have no idea what we're going to talk about. It's nice to see the comment sections lively already. Shout out to the Booty Crew. And
I don't know who
one thing I
came
want to
up
say
with that Booty Crew. I don't think I could hate it more. I know how much you love it.
That's the best part. No, I like you. I hate it too. That's why it's so funny, because it sounds, every time I think of it, it makes me laugh because it's so ridiculous. But what I did find out doing Resolve Rift last week, a Booty Crew came over. They're all in the comments with Booty Crew, Booty Crew. But what I did find out is, I don't think we've ever told the people in the comment section, you and I can actually comment. Jack can, but you and I can't. So what I found out, I asked the Resolve guys, because I know they comment sometimes and they use StreamYard as well. And apparently they have their phones on silent and have the video on that. And then they comment on their phones while they're in the middle. So it's not good
They're
for
a
you and
lot
I to
more
be
clever
commenting
than
and trying
we
to do
are.
the. Yeah. I was just like, how
Guys
the
are
hell are you guys
smart.
commenting? Because wow. Hello from Estonia. Hello, Pearl. Like, that's amazing. It just always, modern times just always blow my mind. I know we've had the internet for a long time now, but it's still amazing.
I want to add something to you said something that this is not financial advice on this Friday. I just want to be clear. This is not financial advice on any day, not just Friday, on any day. This is just the incoherent ramblings of two guys who just made it through the end of quarter, which is always the worst of times. I mean, I don't know about you, Jason. I literally have spent, since market close yesterday, all it has been is gathering data, portfolio attribution analysis. I've written 3.5 commentaries. I've done all this portfolio analysis, end of portfolio updates. We have to deliver all of these portfolio updates to different partners. Then someone on the team has to check that the deliveries went correctly. And I don't know why we do it end of quarter. Like, I know we talk about the big end of quarter rebalancing flows. Like, there is zero reason this has to be done at end of quarter other than everyone expects us to do it end of quarter. And I think I'm just going to start doing my commentaries like mid-quarter. Like, I'm just going to, you know how like companies have different fiscal years? My fund has a different fiscal year. My fiscal year for my fund is like May. I'm just going to arbitrarily choose redefine quarters for myself, make my life easier.
Yeah, I think that, especially coming the guy of a rebalancing timing luck. Yeah, why do we stick to these conventions of these quarters and even monthly? I always have to remind my girlfriend every month, like, turn of the month, because it's just chaos and craziness, right? That the day before and the day after. And people would think that, like, you don't realize, like, just reconciling all the numbers at the turn of the month is always a nightmare. You think it would get better, it never does. And we could talk for days about the jankiness underlying the financial system. And once again, is blockchain solves this, right? I mean, blockchain solves everything, but that is the nightmare that we get at the turn of the month. And then, like you just said, you compound it with the quarterly turn, and that's just but to your point, no, and not only quarterly turn, now people start quoting half a year. So now we finished the first half of 2022. Now we're rolling into the second half.
You get the mid-year outlooks, right? So we talk about the worst first half of the year ever, whatever it is, and then we get the second year outlooks. We're going to get hit with all the second year outlook webinars, or second half of the year outlook webinars. Yeah, it's just the cycle. It's the marketing cycle that we should all just boycott. And yet we won't. We'll just continue lumping along, and it'll ruin my 4th of July weekend. Absolutely. So this is the worst quarter end every year. Except for me. I don't know. Maybe New Year's is worse. I actually don't know what's worse. New Year's or midsummer. But it's New Year. Yeah, they're all bad.
Yeah. So let's before you and I just keep rambling as per usual, let's bring in Captain Jack to get this.
I do like to give people a little bit of insight as to what happens on the fund management side, which is like, when you're a portfolio manager, it's not all fun and glory. It's spending all morning hitting refresh on data streams, going, "Where's my goddamn data?"
Yeah, that actually may surprise.
Well, no, didn't you tweet
people... Go ahead.
Go ahead, sorry, Jack.
Yeah, though that may surprise some people in the comments, but yeah, Corey, you and Jason manage real people's money, and you actually do that job. So I think there are a lot of people who make big macro calls, but they don't manage money. Whereas both of you manage money, which is actually important for people to know.
Yeah, we're the opposite. We actually don't make macro calls and we manage money. So it's the polar opposite of most people that are on YouTube or any sort of financial media. But Corey, actually, did you tweet out the other night that they decided to cut one of your data feeds in the middle of the night without any advance
Yeah, this
notice
morning.
for your futures?
This morning. Well, here's the problem. Sorry, Jack, I'm just going to tangent here.
Go ahead.
If you manage money and you use different data streams as input to different models, you need backups, right? You should never just be one source of data. So one of the services we used started getting weird like 15 days ago. Like it started disappearing off a website and we couldn't find them. And we're like, this isn't good. So we reached out and said, hey, is this service shutting down? No, the service isn't shutting down. You should still have access to it. Lo and behold, the service promptly shut down last night. And now they're claiming they sent me several emails telling me it was shutting down over the last month. I have none of those emails in my inbox or spam. So it's not the end of the world. It's a redundant system. It's a pain in the ass because the other data systems aren't as clean and easy as this one was to use. So it'll, in the meantime, require a little bit more hand-holding for certain processes to run on our side, which is annoying operationally. But then on top of that, we now need to go find another backup and integrate whatever data that is and go through all the legal and getting it all set up, which is just, again, like this stuff is just the operational pain of managing money.
What I love about this, Jack, I don't know if you've ever seen where Corey tries to always tell me he's not an entrepreneur, where running an investment management business is obviously being an entrepreneur. He might just say a business owner. But at the end of the day, what both of those things are is a firefighter, right? And you're just putting out these new fires every day. And it's constantly waking up to like, they did what? So I can imagine what Corey was running through his head when he found out they cut
and it
his
was
data
especially because I woke up at 5 and the way our systems work is like I get emails when in my inbox when certain systems don't work. And so I'm waking up at 5 a.m. to all these emails saying like failed. And I'm like, of course, on quarter end, the one day I just need everything to work smoothly so I can do all my attribution analysis. Of course, all the data's broken. So that's just, Murphy's Law.
Shout out Emma. Shout out Menachem. I think we should get into the topic. Let's get into it. Jason, it's been a brutal month. Stocks, bonds, crypto, gold, all down. Commodities down, trend following flat. Only long volatility is up, but it depends on the strategy. So, Jason, you wrote this question. You said that only long volatility is up. Isn't it true that you have a long volatility fund?
Nothing I say is investment advice, but yeah, we do have a long volatility fund. But I think it's interesting, like even when you have a broadly diversified portfolio, like even a classic Harry Brown permanent portfolio where we've discussed like even risk parity comes out of that and all sort of portfolio construction kinds of comes out of that 4-quadrant model, is you can have months like this where every asset class, bucket or sleeve is down. And people, it's just always a brutal month when stocks are down, bonds are down, gold's down, commodities are down, and then crypto's just a massacre. And then the only part of your portfolio that might be up, like you're saying, is like long volatility. But then even in long volatility, that's a broad umbrella where long volatility is a lot of trading strategies and just classical tail risk equity vol is not paying off as we've seen this year, as everybody's like complaining about. So it's only very specific long volatility strategies that are actually up. Very specific path dependencies have paid off. Just to give you an idea, in generally, it's things like gamma scalping. Push ratio back spreads were doing well, especially like this month. And by the way, this can change next month and next quarter. You just never know. A lot of like cross asset class vol. So if you're talking, rates vol, commodities vol, a little bit of equity vol did well. But like, once again, it was the price you paid for that higher implied volatility. It was hard to make money just trying to hedge with tail risk on long volatility. Maybe Corey can talk about that a little bit more. But my entire point was like, these are months where there's no place to hide. And it's just brutal to be even in a broadly diversified portfolio. But these are what happens sometimes. And what's kind of nice about it is when these months happen, the drawdowns are relatively small, even through that broad diversification. Even though they're all down, you're not going to get wiped out. And that's kind of the general point.
Yeah, you said something there, Jason, that these types of months can happen, even with a really well-diversified portfolio. I would argue they have to happen, right? Because if you were able to avoid months where everything went down at once, you've basically constructed a portfolio that should give you the risk-free return. Like, there has to be risk. You can't neutralize all the risk through diversification, or you're just paying an expensive fee to get risk-free rate of return, or you've discovered some sort of weird arbitrage or alpha source, which probably isn't true if you're investing in well-known things. So just sort of like taking a step back philosophically, like, yeah, you have to have the months where nothing works, just by definition. That has to happen for you to have some sort of positive expected return premium in what you're investing in. So it's frustrating, but again, it's bound to happen. Now, I think where it gets more frustrating is when it's in a month that sort of core asset everyone cares about, like equities, has a rough go. And I think that's when people start to panic a little bit. And my guess is, like, you probably had some clients reach out saying, hey, nothing is working. When are you just going to, like, I don't know, hold nothing but cash? Which is what tends to happen in these cases.
But as neither of us are market timers, I really wonder, though, if this is the backside of what everybody's calling the everything bubble, right? Like, whether these are the months or is it turning over, it's hard for us to know. Like, you and I can't predict the future. But I think about, like, you have all these like perfect storms happening at the same time, with like a supply chain perfect storm, right? With everything going on in supply chains. You have a commodity capex like perfect storm. You have a real estate inventory perfect storm. And then at the same time, you had all of these assets classes that had an inflated bubble over the last 2 years. It's like you're going to have a coming down the other side. So when everything was ripping higher all at the same time, your expectation is everything can drop kind of all at the same time. And there's very few places to hide in a scenario like this.
Yeah, I mean, I'm not sure gold really ripped like other asset classes. I'm certainly no gold bug. Like, small cap value hasn't had sort of the return I think I would have expected it to have in this environment. I think people have been stubbornly long some of the more leveraged assets. I mean, ARK, for example, I think I just saw in the last week or so, had the largest month of inflows, like, I don't know, in the last 2 or 3 years. So people are still stubbornly long some of these speculative assets. Same with crypto. I mean, I know we've gotten a big crypto washout from over-levered trading. But I think at the end of the day, when you have unlevered, stubborn longs, it can take a long time for this stuff to wash out.
I saw today, I didn't have time to really verify, trust but verify, that the inflows into TLT, long duration bonds, were like some of the highest ever. But also that can be some of the highest ever just because like target date funds are some of the highest ever. But what do you think? Do you think people are really like buying the dip, or is this just a structural trade with like with target date funds?
I mean, this could be a rebalance trade, right?
Right.
And TLT itself, like, probably not pension funds, but I would expect, right, pension funds are probably continuing to pile into long duration to hedge their liabilities. So, yeah, I mean, I would expect there will be bid for long duration. Whether it's a sustainable bid or not, hard to say. Again, like, I think people are going, oh, rates are higher, but it's 3.5, like, really that interesting? Is 4% really that interesting given inflation levels that we're seeing now? I don't know. I think you have to have probably a strong view that inflation is going to get capped, and that in doing so, we're going to push ourselves into a recession and the Fed's going to cut, and then long duration isn't a bad play. But you got to really be ahead of that trade. And a lot of people are speaking for that trade now, but you got to be ahead of it, and you got to get it right.
Do you? I was, because last week we kind of shat on some Bitcoin pontificators about Bitcoin front running inflation. So we're equal opportunity here. So what I hear from a lot of the gold bugs this year, gold is essentially flat, maybe slightly down on the year, and they're saying that's the outperformance compared to 60-40. So they're saying that gold being flat is actually where you're getting the outperformance for gold on the year. Do you buy it? Do you buy that argument?
Gold being flat versus the dollar.
Yeah,
right.
Well,
Isn't the whole point like you're supposed to have positive real returns? So if it's flat versus the dollar, which is being inflated away, isn't that negative real returns? And isn't the whole argument?
I'm saying we equal opportunities here. Yeah.
Yeah. I mean,
not,
if you're going
not
to keep
against
changing
the yen or the euro, just saying.
Well, yeah, it depends on what country you're in. Yeah.
Yeah.
Sure. Which has always been, by the way, my issue whenever you talk about inflation. Who's inflation? Right. I guess in a global economy, you can have sort of global inflation, but like when I'm buying gold, Am I protecting myself from a devaluation of the US dollar? Or am I protecting myself from a devaluation of the Zimbabwe? Whatever it is. I actually don't know what their currency name is. But you get my point. Like, I think the need for currency hedges sort of depends upon where you live, and the appropriate currency hedge probably changes where you live. But I don't know how you can say the whole thing you heard over the last decade was gold as a hedge against changing real rates. I'm not sure we've seen that.
Right. That's why that was giving you a chance to to equally shit on everybody.
Yeah, but here's the thing: all you're doing is you're setting me up to say things to piss off gold bugs. Yeah, it's like that's like a real burner move, man. Like
that's because last week I pissed off Bitcoin maxis last week, so you're just
Thank you for the layup. I'm sure my mentions are just going to be, my DMs are going to be great for the next week.
Just forward them all to me. Your email is Jason at no.
That's right.
Jack, please save both of us.
All right, Jason, what's up with the meat industry? You write that we have an everything bubble perfect storm, and that the meat industry is about to have a supply chain issues. What are you talking about there?
So I anecdote is not data, but I love a solid anecdote. And I was talking to a buddy of mine that's a rancher in both Colorado and Texas. And what he was telling me the other day, once I was saying about these perfect storms of supply chains, everything, I think that agricultural inputs can also be in a perfect storm. And we don't realize like we may not even have seen an explosion in food prices yet. Now, granted, once again, I can't predict the future, so take this as a caveat emptor. But what's interesting, I was talking to this rancher, is that they typically in Colorado will get hay from Arizona and Utah. But right now, because we're in such a massive drought in California, all of the hay is getting sent to California from all the other states because they can pay the highest price. So when it comes time for states like Colorado to then need hay for feeding seasons going into the fall and into the winter, hay may not be available for these cattle ranchers. So once again, it's these input costs, whether it's energy input costs, and then obviously one we'd never think about is hay. That's why I love like just a random obscure anecdote like this, and thinking about how the hay market could potentially affect our food prices moving into the second half of this year.
So talk about some of the benefits of social media. I don't know if this is a benefit or not, but you know how like there's FinTwit, like a whole community. Yeah. There's like farmer TikTok, and it's the same, like it's farmers who were just complaining about what's going on. So the other thing I was basically hearing about was I think it was like diesel costs. Mm-hmm. Like diesel costs have gotten so absurd for farmers that for them to possibly come close to turning a profit or just being in the black or breaking even, the food cost shock that we're going to see over the next 6 to 12 months is going to have to be pretty dramatic, right? Now, whether they end up eating it or not, you don't know whether the big conglomerates are hedged and the small farmers just end up suffering, or how this all sort of meters out over time. But yeah, again, this is sort of the bullwhip effects of supply chains, right? That become very difficult to predict and can have long fat-tailed impacts over time.
And once again, I just always like to give a shout out to the beer game. Everybody Google it, go play the beer game, and you'll learn about what Corey's just referencing with bullwhip effects and supply chain dynamics. And it's so interesting because the beer game is right about beer supply from the plant through the wholesaler, the distributor, and the end retailer, and how just different perturbations along that chain can lead to large bullwhip effects going up and down the chain. But that's only one chain, right? And then you're not even talking about like the agricultural products that go into making the beer, like the hop farmers, et cetera. You don't have all the transportation cascades that go throughout that. So it's like you start having multiple integrative complex systems there. It makes it incredibly difficult to figure out. And not surprising. Like to me, it hasn't been surprising at all. It's like, we've hit the stop button on the global economy. Didn't you think you were about to get the largest bullwhip effect in world history over the last 2 years, right? And then the startups, and then China re-shutting down and everything else. But you combine all of the pandy-wandy shutdowns and those bullwhip effects. But then you're combining, that's what I'm saying. What I'm also worried about is like, besides the supply chain, you have the commodity capex perfect storm. You have the real estate inventory perfect storm. It's like we're going through these all at the same time. And it's just like almost this unfortunate serendipity of all kind of concurring at the same time. And I think I even showed you, I I live in Napa Valley, which is essentially an agricultural area, right? We grow a monocrop of grapes, right? And people don't realize it's just a monoculture there. But I think I sent you a photo. I took a screenshot because where I go get my coffee in the morning is at this gas station that has diesel. And I think I showed you one of the pump prices was $532, to give you an idea of like how much people are spending on diesel to be able to then grow agricultural products.
So I'm going to take a total tangent because you were talking about real estate.
Please.
Real estate is one of those, we talk about prices that have been going up. And by the way, to bring this back to investing, I mean, you and I started talking about the bullwhip effect last year, over a year ago, right? I think it was something we discussed on our channel previously. I think what becomes very hard with the bullwhip effect is you can say, I think the bullwhip effect is going to happen, but you don't know where it's going to materialize necessarily, right? Or when. And so playing the bullwhip effect can be very hard. I personally think one of the better ways to play it is with commodity trend, because those prices will start to move and run away. Probably harder to get the convexity unless you really get the timing right with options. But it's one of the reasons I like commodity trend. But we are starting to see from that everything bubble hype die down. We talked about watches last week. Real estate is one I've been watching closely. But I got a funny real estate story for you. So, my wife and I are renting outside the Boston area right now. We're looking to rent in Florida. And we've been hoping to move in like September 1st in Florida and struggling to find places. My wife finally found a place. They were charging X. And then we said, yep, we'll take it starting September 1st. They really wanted to start renting July 1st. And asked whether we would take it September 1st, but they tried to increase the price. And I said, no, I'm not going to. You advertise it for X. I'll take it for X. And it's up to you to figure out what to do over the next 2 months. So they never get back to us, which means application denied, basically. And then I just see that they relisted it for 20% off of X starting July 1st. So I do the math and I go, okay, I'll just save money, take it then. And I'm going to save money.
Over the next year. Yeah.
If you had just taken it and let it sit for 2 months, you would have made more money from me. But sure, I'll take it starting July. So we applied for July 1st at the new rate. And I mean, we haven't heard back yet, but fingers crossed that they say yes. And I'm sitting here going, either they are just so desperate for cash today, right? Like they just need the money in the door today, or that tells you about the entire real estate market. Because it's not just, I'm seeing prices cut everywhere, listings cut everywhere, but you're starting to see rental markets get hit too.
Yeah. And then Menahem saying we're going to see a monster uranium bullwhip soon. He said I can feel it in my plums, but also Menahem's kind of speaking his own book there. And you and I don't have intimate knowledge of the uranium markets, but it's been one of those ongoing kind of bull markets. We'll see if it tends whipping higher in uranium or what's kind of going on there. Captain Jack, do you want to come back in?
Yeah. So Corey, you said that you and Jason have been talking about the bullwhip effect since last year. I've been talking about the bullwhip effect since 2017. No, I'm just kidding.
Oh, here we go. Here we go.
All right, next question. All right, this is a story I know it's near and dear to Corey. Tell us what's been going on with the AQR Market Neutral Equities Fund. It's finally been crushing this year. Long value, short growth, but what about the past? Jason, you want to start off?
Yeah, Corey, this is a ringer. I don't know if you got to see these questions beforehand, but I just love that people are posting that. If you look at this year, and my point with this was not to pick on it. And we both love AQR. Every firm's great. All that good stuff. But it's more about when you're talking about quarter end or half year end. Is now it starts coming out who are the best funds in the first half of 2022? Who are the worst funds in the first half of 22? And so finally, AQR is getting its comeuppance with its market neutral equity fund. But then if we zoom out, it's over what time horizon are you looking at? So to me, more, softballing up this question was the idea of how do we even assess, what time horizon we're actually looking at? And I'm not setting you up again, even though I know you think I am.
No, look, so AQR, a very, very famous quantitative manager, has historically run its strategies in a very diversified way. So sort of the two big funds, the big fund that really raised a lot of assets in the alternative space was their Style Premia fund, but their equity market neutral fund, which was sort of same idea of Style Premia, using all these different quantitative signals, value, momentum, defensive, all that sort of stuff, implemented very specifically in equity markets. I will say QR is known for using what's called an integrated approach, where they are using all those signals to pick simultaneously to pick stocks, and they are willing to take tactical bets. So they've been leaning more heavily into value as the value factor has been out of favor. They had a tremendous run in with those products out of the gate, did really, really well, and then got absolutely smoked. And I think a lot of people were really frustrated by the performance. Of course, you had performance chasing on the way up. People got in too late. Everyone sold on the way down at the bottom. And since sort of, I guess, Q4 2020, both their style premia and their market neutral funds have done exceptionally well. And I think over the lifetime, if you just go point to point from start to present, they look like you would be like, okay, that's a good return. It's just whether you could survive the path. And I think this is the frustrating part about diversifiers, particularly if you're not going to look at your portfolio holistically, if you're going to only evaluate them on a line item basis, because you would have eaten like multiple negative big years in these funds to get eventually to these multiple positive big years that would have been a great diversifier when equities were going down. If you looked at, say, your average 60-40 and layered these on top and did it with some other managed futures diversifiers, which, by the way, is how AQR talks about this stuff, you're using multiple diversifiers together. Honestly, it doesn't look that bad on the portfolio. And in fact, over the long run, it's added value. It's just if you look at this stuff as a line item, it's very frustrating. So look, diversifiers are meant to diversify. They're meant to be, well, we got some great comments going on.
Jack, you might have to kick somebody out there. Yeah.
Right. Diversifiers are meant to diversify. My friend Brian Portnoy has a great line, which means, being diversified means always saying you're sorry. Like there's always something in your portfolio that you're frustrated about. You've been frustrated about, AQR for 3 years. Those people who capitulated sort of passed all the alpha to the people who had the diamond hands. And I think if you're thinking about structural diversification and really doing this stuff, you do need the diamond hands implementation in your portfolio. I mean, Jason, look, you run a massively diversified portfolio, right? You see all the line items. I have to imagine that on any given month, any given quarter, any given year, there is something in there that is just like, you could pull it out and go, this is horrifyingly bad.
It's something in there, 20 to 30% of the portfolio, usually, sometimes upward to 50 or 60% like this month. But that's like, I teed you up perfectly. The idea was like, okay, the market neutral fund, or like choose value investing, right? Like, I don't understand how people get so religious and zealotry about like value investing, right? And then they hold through all these down periods, and that's the only actual product they hold, or trading strategy they hold, where you and I believe in broad diversification, because how are you going to ride through those lulls in any form of trading strategy? So yeah, it's not picking on a specific strategy for AQR, because as AQR believes, broad diversification, you should be having this in conjunction with a broadly diversified portfolio that have offsetting either uncorrelated or negatively correlated strategies. And so that's part of it. But I was wondering too, is like, do you think, I don't know if I've ever asked you this, part of it is like, I always think about capacity constraints, and AQR has been so successful. Do you think they get to a point where they're almost like running too much AUM for some of these like more niche strategies?
It's entirely possible. They've written quite a bit about market impact. Yeah. I think a lot of people were saying, hey, it looks like their managed futures fund is massively underperforming peers. Is that because of capacity issues? They raised so much money in it and it was just having too much market impact. I don't know. Now it's having a great year, right? And it's not like its assets dropped so much that it shouldn't still be having capacity issues. So I think some of this stuff like becomes self-fulfilling from a narrative perspective. I think often there's more autocorrelation to these trades than we suspect there is. When something goes out of favor, it can stay out of favor. It's not just always random noise. I know people who think that some of these factors can be trend followed, right? When value starts outperforming, that's when you should lean into value. When it's underperforming, lean out of value. Don't just use, pure diversification. You can time some of this stuff. I would argue the more diversified you are, not just argue, mathematically this is true, the more diversified you are, the higher the hurdle rate there is for adding value through timing. So you really want to maximize your diversification first, and then, to steal a quote from Cliff, just sin a little when it comes to market timing. But I think I don't know. I think at the end of the day, people were loving it when it was going up, hating it when it was going down. But I think it just is like zero correlation to equities. So yeah, I mean, the same way we hate equities when they go down, it's probably easy to hate on market neutral style premium type strategies, probably even more because they're more of a black box. We don't understand them as well, right? At least when I buy equities, I can be like, well, I'm buying a business and I'm buying cash flow and there's something tangible there. When you're buying some weird trading strategy, you do wonder if it's just like perpetually going to zero because the alpha's gone. So I think they're harder to stick with, but they're back. They're back with a vengeance.
I'm gonna actually steal a couple quotes from our buddy Med Faber. They said when people ask him like how long, what's a time frame I should use to assess a strategy, he used to say a decade. Now he says 2 decades because like they go in and out of favor over long periods of time. But Meb, just like us, believes in broad diversification. And the other Meb quote I love is he says when people call him up to ask about the funds, he's like, you're calling about the one that's in the biggest drawdown, right? And he's like, no, they're always calling about the one that's at the new peak of the equity curve. And it actually happened to me the other day. And the client was like, why wouldn't I invest in this? I was like, because that's performance chasing. Like that's.
I had a wholesaler. This is a great story. I had a wholesaler who worked for me once, who prior to working for me worked for a firm where he had a number of mutual funds. And one of them that he was sort of their flagship fund was a very well-known value manager. And so he used to visit this advisor and he spent 6, 9, 12 months really educating about the process of how they were picking stocks in this portfolio. And over that period, that manager had a great run. And the advisor kept saying, yeah, I get it. Yeah, I get it. I just want to see the performance materialize. I really want to understand it. I want to track it. I want to follow it. So it has this outstanding performance. He comes back. He says, all right, are you ready to buy? And the advisor says, well, now I think I missed all the performance, so I don't want to buy now. And the guy turns around and he goes, well, I got a bunch of 1-star funds. You tell me which one you want to buy now. It's like, you can't win either way.
There was in the comments, there was a question by Sean Weiland I thought might be interesting for you because I don't think you and I have ever really talked about this, but it was about dividend investing in Daniel Paris. And I think like Meb and maybe Alpha Architects, and maybe you've done it too, is like there's all these great tests that show that like dividend investing based on the tax consequences and then the kind of return stream you get from dividends compared to the price returns is you're actually kind of better off avoiding dividend stocks. And actually even the dreaded buybacks are actually even historically have been better. Once again, historical timeframes are use your thought process of what are the context we're looking at. But I would think for Daniel Paris's philosophy, I thought his philosophy is compelling, that he believes that we're going to go basically, and I'm putting words in his mouth, so forgive me, back to like early 1900s where everybody was basically a dividend investor, and we really care about cash flows and getting dividends. But to me, so much would have to structurally change, including the tax code, for that to make sense. And I'm just this is just a hot take I'm throwing out at you, so I'm curious your thoughts.
Yeah, I have looked into this, and I think the problem with just saying dividend investing is there's really 2 different types of dividend investing. There's people going for dividend yield, and dividend yield is historically just a really shitty measure of value. When you buy higher yielding dividend stocks, you tend to be buying something that kind of looks like credit default risk. It kind of looks like value investing, but it's really not a good value investing signal. And so you're buying something that's historically tax inefficient and a bad value signal. You'd be better using other value signals. The other way people do value investing is focusing on companies that have been growing their dividend over time. And the problem, as you point out, is the tax code changed to make dividends less advantageous versus, say, buybacks. And so you have a bunch of old school companies that are doing dividend appreciation. A lot of the new companies aren't. The argument for dividend growth over time, companies that are constantly growing their dividend, never cutting, is that you're focusing on, it's a way of measuring company quality, right? The only way that can really be achieved is if the company has a strong, healthy balance sheet. I mean, that isn't to say always. They could, like, there was a ton of financials in the dividend achievers universe in 2007. Half the universe disappeared in 2008. But in theory, it's a quality screen. And then the other one is you're literally taking cash away from the operators who you think are long-term destructive to capital. That operators tend to, when they get capital on the balance sheet, make destructive investments because they want to be seen as doing something versus just distributing it. If you go with companies that are willing to distribute it, they're much less destructive with their capital. It forces good governance because they have to do more with less. So there's two different ways to sort of think about the dividend game, and I think sometimes we conflate them. The first one, I think I agree with Meb and Wes, who's written about this, is like pure high yield dividend investing is like just really shitty value investing.
Yeah, because there's no company ever is like, oh, I'm going to pay a 20% yield. It's like the stock's at $20 and they pay a 40-cent dividend a year, and then the stock goes to $2 and or $1,
Right.
and then that's how they have it get a 20%. It's just the stock goes down. So it's by definition like the opposite of trend following. It's like betting that a stock that went from $5 to $1 will go to $5, which not a good bet. Yeah,
but also part of that before we move on. Sorry, before we move on, Jack. The other part of it too is like, Corey, I'm curious. Like, everybody wants these long historical backtests, but like pre-World War II, we're all basically divvy investors, right? Like you're actually getting large payouts in dividends from stocks, and that's how people assess their investments was actually on the dividend yield. Not necessarily, they weren't necessarily worried about price appreciation as much. So it's like the markets have completely changed.
Yeah, and look, I think if you're a savvy operator of a business, the decisions you have are typically right. You can pay dividends, you can pay down debt, right, or you can buy back stock, right? Those are the three major ones. And I think it's a little silly to only have a strategy where you're rewarding those people with your capital that are paying out dividends, because that could be the suboptimal choice compared to, say, buying back stock, right, or paying down debt. Like you want to make sure the operators are making the right decision. So I think there have been big steps in the last kind of 12 years or so where people are focusing sort of away from just dividend yield, looking more at total shareholder yield and shareholder yield growth over time. But you don't have a shareholder yield achievers universe the same way you have a dividend achievers universe. Who knows? Maybe it'll come.
Another question I haven't thought through that came from like Menahem, because he's talking about the shipping dividend payouts are totally insane right now. I haven't thought about this correlation, but I'm curious your take. This is just off top of my dome. Is when we talked about like crypto yields, like those yields are so high because you have commensurate risk and you have to assess the risk. So do you feel it's almost the same time with dividend yields? It's like if the yield's extremely high on a dividend, you're taking commensurate risk at the company level as well, or?
Yeah, I mean, in theory, right? Because otherwise it would be inefficient. People, right. why does a stock have just sitting out there with a 20% dividend yield? Like if it's that high, you would expect well, I guess it's a little weird, right? Because a dividend yield itself, like the stock is going to drop by the amount of cash on the balance sheet. So it's just a shuffling of where the money is. It's either in the bank account of the company or your bank account. So I don't know. Dividend yield really shouldn't matter. Normalized dividend yield versus peers being higher does typically say something about risk, though.
Yeah, as someone who, actually today I think I just got a dividend from like the shipping ETF, and like, the dividends are huge, and those shipping companies right now, they defy the rule that I said of if you have a company that yields 15%, it's because it used to yield 5% and got cut in it went down 66%. Yeah, like there was a company that ZIM that paid off, obviously not investment advice, that paid off like a $17 dividend, and when it was an $80 stock for one quarter, and it had gone up ever since it IPO'd in early 2021. So, but shipping, that it can't last. Like the shipping industry, you've had a huge the shipping companies, to use a Jim Chano's phrase, have been over earning because of the supply chain crisis, and like they're not going to last. All right, let's move on to the next topic.
Can I answer a question that's in the comments actually?
Sure.
Please choose the one I want to choose. Please choose the same one.
Van is asking me why am I renting instead of owning my house condo? So I will say I did own a condo from 2011 through 2018. Bought a condo in Boston, and it ended up being a great trade for me, though I wish I had done it with more leverage. I actually think the capital I put in there would have been better off from a total return perspective in the market. The reason I am choosing to rent is twofold. One, I'm moving, and I don't know the area I am moving to. And so therefore, I don't want to buy into a new area without really understanding whether I want to live there in the long term. So that's one big one. Two, I think depending upon your net assets, your lifestyle, and your expected returns, it can be suboptimal from a financial perspective to own. Because the relative choice you have to make is how much debt are you taking on? What's the potential asset appreciation of a very idiosyncratic asset versus what else could you be doing with that capital. And there are plenty of calculators online that you can work through. And for where I am at my stage of life, almost all of those calculators agree that it is financially suboptimal for me to own. That said, I'll probably still buy a place if I really like the place I'm moving to, because buying a place is not really a financial decision. It's a lifestyle decision. If you look historically, property markets always have like almost certainly underperformed equity markets on a cash on cash basis unless you're renting them. The rental yield is a huge part of property valuation. So the house you live in, other than the tax advantages you get, is unlikely to grow like equity markets unless you're using a substantial amount of debt, like you're levering up the trade. And then it's just a question of the trade-off of leverage in equity markets versus leverage in the real estate market with a really idiosyncratic property. So I'm not sure real estate is as good a financial bet as a lot of people make it out to be when you really do the math behind it. But for me, the reason I'm not buying right now is because I've been moving around for the last 4 years, and moving again, and I don't want to buy in a place I don't know.
That's perfect. I can't believe like how many times I've had these conversations about buying versus renting, and you have to actually really do your own commensurate spreadsheet. Especially like you or I have other things we can invest in that we think are a higher use of our capital than real estate. But like especially right now when you're moving to a new place and you don't know where you want to live permanently, it obviously makes more sense to rent, because part of that we were talking about before we came on live today is like your time horizon, right? Like even on a 30-year AM, for the first 7 to 8 years, you're paying interest only to the bank anyway. You need to like get past 8 years to break even, where the average American only lives in a house for 5 to 6 years. And then they're not factoring in all costs. To me, like when people talk about real estate and their how much money they made on real estate, it's like fishing stories or golfing stories. Like it's grossly exaggerated because they don't factor in like transaction costs of both getting in and getting out of the property, their maintenance costs over time, taxes, etc. People don't really factor those things in, or even the commensurate, lost value that you got from not investing in something else. And then, me coming from, past life, a commercial real estate development background, I think about everything in cap rates. And depending on where you live, like a lot of places in California, for example, you can rent for basically a 1 cap. So it's like your cost versus actually owning the home is about 1%. So, you have a tremendous advantage over buying a home and paying the mortgage rate, your PITI. And so that's the other thing you have to factor in, especially, you miss out on that property appreciation. But at the same time, for most people, the reason real estate really works is because 1, they're delusional about the property appreciation. But 2, as we all know, it's a forced saving mechanism. That's a leverage forced saving mechanism. And people like you and I don't need that forced saving mechanism. We're putting our money to use in other ways that we're happy with. It doesn't mean that we don't think people should buy homes. If you want to buy a home, go out and buy a home. But I don't think a lot of people actually go through the process of factoring in what the costs are from renting versus buying versus opportunity costs from other things they could be investing in.
And that doesn't mean, by the way, that real estate shouldn't be part of your investment portfolio.
Right.
It just doesn't. I think for most people, it ends up being the dominant part of their investment portfolio when they look at their total human capital and investment capital balance sheet, right? Because a house is one of the largest purchases anyone will make, and it's a massively levered purchase. Sean points out that it's massively subsidized by the government. I agree. Again, this is some of the most tax advantage way of saving and getting leverage that you possibly can get. And as you move, you can keep rolling over, right, those taxes. So it is massively incentivized, but you can back all of those things out and still decide for yourself whether it is financially appropriate. For me,
It's just
I've done the math. I'm not sure it is.
It's just like we were just saying,
and yet
talking about
I
dividends,
probably will still buy a house, right?
Yeah.
Yeah.
Well, it's 2 things. It's like we were just talking about with those dividends is like if government structured it so it's like tax inefficient or tax efficient for you, like those incentives drive a lot of the purchasing, whether you realize it or not. And like you just said, it's like even though on a spreadsheet it may look irrational, a lot of times a home purchase is irrational, and that's okay too, because like you just want a permanent fixed place to start a family, and that makes perfect sense.
And I mean, look, I one of the reasons I bought a house in 2011 was because I wanted the solid roof over my head while I was building a company. So I was taking huge entrepreneurial risk, even though I don't consider myself an entrepreneur. I was taking huge just business risk, and I didn't really want the living situation risk. So, and now I have less of the business risk. I have a larger personal capital that sort of serves as a cushion. I don't necessarily need the real estate, and nor is it necessarily the optimal investment strategy for me. So to each their own. Everyone needs to make their own decisions about this stuff. I just think we are raised here in the US that real estate is the dominant asset class ever. It's the American dream to buy a home. I think if you sit back and actually do the math, it doesn't always necessarily make sense depending on your personal situation.
Well, and what people don't realize, like you just said, in America, because this is almost along the lines what Menahem was just saying, and according to what Sean was saying too, is like we don't realize that we're one of the only countries in the world with non-recourse loans for home ownership, 30-year amortizations, and you have the optionality of being able to refi. Like those three things, like most of the world does not have. So we have an extraordinary privilege in this country when it comes to buying real estate. By the way, just a side note, Rajiv asked he would love to hear my inner dialogue when I think about should I eat that donut or not. It's really this simple, Rajiv. I see donut, I eat donut. Therefore, I don't have donuts in my house. Captain Jack.
We got a question from a viewer, Jason Buck, who says, you also ask about the Elliott management on odd lots, EM debt in dollars or super senior rights now with China, Peru, Ecuador, and Sri Lanka riot. So, Jason, can you explain that comment, please?
That Jason Buck guy sounds smart.
Yeah, I was like, I got so confused at first. I didn't realize what Jack was saying. Oh, I was watching one of the latest Odd Lot, or listening to one of the latest Odd Lots, and shout out to Odd Lots. It's you and I is one of our favorite podcasts. I don't think you've listened to this one yet, but it was actually one of the guys from Elliott Management, which I would love to know what. Speaking of my interior monologue, I would love to be inside the walls of Elliott Management to like. If you don't know like the saga of all the things they did to Argentina to try to collect on that debt, it's quite fascinating story if you ever have the time to read it. But one of the things they were talking about was really interesting right from the beginning. He was saying that he doesn't think countries should be allowed to borrow in dollars. And he's like, it really just makes that simple sense. He's like, talking about Sri Lanka, he was like, everybody says, well, they have to be able to borrow in dollars or else they wouldn't be able to borrow in their home country currency. And he's like, well, then they shouldn't be allowed to borrow. It's that simple. So he's like talking about the ability to borrow in recourse.
Who cares what they borrow in? They can just get a swap.
Right, but then you don't have the printing press to be able to backstop it. You know what I'm saying? Like, yeah, assuming you would, but that's not what people do, right? And then if you have
but to me, it's just I don't know. This is kind of silly. This is a trade-off of risks, right? Because if I'm a country that's borrowing in dollars and I'm getting taxes from local printing press, right? There's getting taxes or my own local printing press. Like the financial market is going to have a swap rate, a future swap rate between those currencies that is taking that risk into account. So like, okay, if you don't like the fact they're borrowing in dollars and you think it represents a financial risk, then there's a trade there for you. Like all this stuff can be hedged. So who gives a shit?
I love the non sequitur. It's perfect. But sorry, I'll go on. The other thing they were talking about is whether it's Peru, Ecuador, Sri Lanka. We're seeing all these riots now. Is a lot of times in these scenarios, whether with these loans to emerging markets or emerging economies, is like a lot of them are coming from China now, and China is setting up super senior rights, and it's up to China whether they're going to roll that debt or not. But also what he was talking about is like they're also not transparent. When anybody's trying to get information about what the debt structure looks like and who has the super senior rights like China, they can't get any information from China. And it's part of that, Belt and Road Initiative is they're the ones now maybe lending en masse to like African or South American countries, trying to help them build their infrastructure. But just like, like we've done in the past with America through the IMF, is like we do that a lot of times and provide infrastructure loans so that way we can force countries into default and then use them as a voting bloc, at the United Nations. So it's just like an interesting conundrum that now we're getting into, as emerging markets are starting to have higher food costs. Will they start defaulting on that debt again? And what will China do in that scenario?
So, Corey, can I just provide a little bit of context? So I think there are swap rates, but those like if for Turkey to borrow in dollars and then hedge it out, you're right. That would be the exact same. That would be the exact same exposure as for them to just borrow in lira. But that is prohibitively expensive for them. That's like them paying 12% an extra year. So what people do is by borrowing in dollars and not hedging it. So the guy, I didn't listen to the podcast, but Jason's saying is that the analyst there is saying is they should either borrow in their own currency or borrow in dollars and hedge it, which is essentially the same thing. And yeah, Legendary says, good sir Corey, have you seen the cross currency basis swap? I think which is just like
I have, but I guess my point is like the people who are lending the money are aware of this, right? The people who are lending the money are afraid of this risk. They can hedge the risk. or that's what they're expecting to get a higher yield on the debt for. Like that, this is how markets work. I don't know. Like, I don't know. I don't know what to say that they shouldn't be allowed to borrow in another currency is a little silly to me.
Yeah, maybe they shouldn't be allowed, but they shouldn't. They shouldn't borrow in another currency. Not that they shouldn't be allowed. I don't know. It's just risky. Yeah.
Well, it's risky, and that's all we've seen is blowups, and because of that, and then the companies like Elliott will go after them over time and spend a decade trying to get recourse on that loan that they provided and recoup the pennies on the dollar they paid for, and hopefully get a delta between that. And it was just interesting to hear that from somebody at Elliott Management versus like a different side of the story.
Here's what I'm going to assume. I'm going to assume I'm too stupid to understand the nuance of what they're saying at Elliott, and I'm just going to have to go listen to the podcast.
No, I think you're also. I mean, I think you're right though too. Not to change. So, Jack, are you wearing a South Carolina hat or is that just a palm tree hat?
It is a hat I got at a crypto thing, so I think it's a crypto hat. I don't know exactly what company it is, but
I couldn't.
Yeah, it's not an advertisement. So Ganymede asks, I think those on Celsius didn't know about risk, and I think that's a perfect question to our final question, which is Sam Bankman-Fried the new J.P. Morgan? Not J.P. Morgan the bank, but J.P. Morgan the man.
The man, yeah. So I brought this up because if any of you haven't studied the man J.P. Morgan, John Pierpont, is the idea was during 5 economic crashes, he was the only one left with capital. So he would tell people, your price, my terms. And that's how he screwed everybody. And he made all of his money. He would during these recessions or crashes. And, you can go back to the history, whether he's bailed out America, created central banks, all these sorts of things that JP Morgan did. So it just popped into my head kind of earlier today as we have Sam Bankman-Fried or SBF, and whether it's via FTX or Alameda, as they're just bailing out the entire crypto market. Is this just another example of like JP Morgan trying to save the environment they're in?
So what's really interesting to me here is it's happening through a number of different vehicles too, right? Mm-hmm. So he has set up FTX in a way that like there's no umbrella company. You've got FTX US, you've got FTX in Germany, right? You've got FTX in Hong Kong. Then you have Alameda, like the hedge fund. And all these bailouts are getting labeled as Sam's doing it, but it's the different entities individually that are doing it. Like I think it was FTX US was the one that entered into the credit agreement with BlockFi with their right to buy out. Like it wasn't Alameda. Alameda, on the other hand, was on the other side, I guess, of some of these other institutional bailouts that happened because Three Arrows Capital was defaulting on all their debt. So it's like, yeah, it's all Sam, but it's all these different institutional versions of Sam around the world that are negotiating all these deals. I find that to be like a interesting wrinkle. It's not like Goldman in 2008, where it's one institution that's accumulating all this power. It's like these little institutions that, yes, Sam's the common element, but there's no umbrella company to them all.
But also part of it, like, I find it so fascinating. Like, I've never been able to wrap my head around when people can burn through billions of dollars, right? Whether it's Three Arrow Capital, blow up. There's always blow ups in TradFi as well too. But like how people are able to incinerate billions of dollars, I'll never be able to wrap my head around. And one of them was, a lot of people have been talking about with the BlockFi. At one point, BlockFi had raised over $1 billion, right? And now FTX is buying them for $25 million, as the headline reads. But also, to not be disingenuous, they also had already provided them with a $250 million credit line, so it's not just $25 million. But like it's just it's just
BlockFi just announced the official terms like an hour before we went live, and they're not actually buying it for $25 million. It's a very different deal than that. Doesn't. But
either way, like everybody's like, where were these VCs on due diligence for raising $1 billion in capital though? And then shortly thereafter, whether it's 25 million, 250 million, those sorts of things. It's just amazing to me how people can incinerate billions of dollars when you're supposed to be doing due diligence. But it's just something I'm never ever going to understand.
One of the things I certainly appreciate crypto is there's some very colorful characters on Twitter, and one of them the other day tweeted something to the effect of, "I don't understand why everyone's naked when the sea goes out. Why don't they just wear shorts?" Right? And it's like, I mean, it's funny, but it's like, yeah, you sort of see that these VCs that in theory should be doing due diligence, I think are just as prone to FOMO. And these rounds that were happening over the last 2 years were getting so wildly oversubscribed that people were fighting to get in them. And when you're fighting to get in a round, you don't get to do due diligence anymore. And that's when you tend to see a ton of malinvestment, right? Now, I know you hate that term, right? But the reality is, like, when there's a frenzy for capital allocation in a certain category, you tend to see a lot of people allocating to stuff that they wouldn't have otherwise had they had the time to do their due diligence, and they're foregoing the due diligence because the opportunities are going to other people if they try to press on it. So yeah, BlockFi, I think, has probably got to that point of it was big enough that by Series D, are you saying, wow, I assume that people in Series A, B, and C did their due diligence, right? How much more due diligence do I have to do at D? Well, the answer was a shitload more. The company changed and the risks they were taking dramatically changed over time. But I think, again, when these rounds are getting oversubscribed, it can be hard as a VC to demand due diligence because there's other people that'll do it without due diligence.
Perfectly said. In a bull market, and you want to just get in, and people are saying, sign the term sheet right now, no questions asked, and you go, well, A16Z's in there, they must have done due diligence, so that I'm going to use a proxy due diligence. This is what happens. And it was making me think about Jared Dillian was on Hidden Forces maybe a couple weeks ago, and he was talking about, it's a tautology, but he was saying that the bull case is always looks rock solid at the new high point, right? And same thing with the bear case, always looks rock solid at the absolute lows. And obviously that's a tautology, but it's interesting that that's human nature, right? Like you were saying, almost a malinvestment is like we go in these enormous bands of over and under representing reality because it's just human nature. Like we just are that. Stability breeds instability, and that's why when that the markets are running hot and the VCs are trying to jump in more and more, and the term sheets get less and less, and they get less and less due diligence, and they're able to do that because they keep marking prices higher and higher, and so then you're taking on larger and larger positions until just a little speck of sand in that sand pile leads to a liquidity cascade.
So our mutual friend Adam Butler, he was telling me about a phrase. What are they? Polar traps. I feel like you would know this. You've definitely discussed it with him. This idea basically that like one actor misbehaving can force other actors to misbehave, right? So imagine you start to see the crypto space take off and people are trying to raise money, and you have one VC that's just willing to start writing checks without doing due diligence. They now represent a threat to VCs that are forcing due diligence, right? Because they're just saying, hey, we'll be the people that write the checks. We'll be first in the round. We're going to take up the space. And that now allows sort of forces the other VCs to have to lower their due diligence standards to get in the rounds quickly enough. So if you get this sort of like forced bad behavior because there's one actor who's misbehaving. You see it in the investment space as well, like with back tests, for example. Like you get someone showing a ridiculous back test to people who don't understand what a ridiculous back test looks like, and they raise all the money. So now you wonder why everyone's running around showing ridiculous back tests. Well, because it's the only way you can raise money and compete with the bad actor. Because you can't compete with a bad actor when you're going against maybe a less sophisticated audience by being more sophisticated. It doesn't work. And so there's these I think he calls them multipolar traps or something like that. There's a name to it that I'm probably butchering. But this, this idea, it just takes one bad actor to cause the whole thing to spiral out of control. And I think you saw that in crypto. And that invites, I saw a lot of people who shouldn't have been doing VC. Like, why were market makers becoming VCs? And like, what does a market maker know about being a VC? Right? But they were, right? And I think you just saw a ton of FOMO, and that now it's all blowing up.
Yeah, and Scott in the comments said it perfectly too. It happens in real estate as well, whether it's residential real estate in a bull market and people start waiving their ability to have inspections or whatever. And then in commercial real estate, we call it like covenant light loans. You can start getting non-recourse and very few covenants on commercial real estate right at the peak. And that's almost like a signifying force where we're getting pretty close to that turn. Captain Jack.
Yeah, I totally agree. I think the VC bubble, you said, it's only begun to start correcting. And I'm looking at podcasts that are going to de-SPAC in a few days. Like, there are podcasts that have SPACs.
First of all, Jack, why is this the first time I'm hearing of this? Why have we not SPAC'd this podcast?
We should. It could be very lucrative for us, and we'll get all the warrants and So I agree. So actually, guys, we are out of topic. So unless you propose another topic, I have to say you guys got to break the news to the audience. The audience is about this chat is about to go wild. Jason,
so
you want to do it?
I guess I will, even though Corey's more eloquent than I am. So this is actually our last episode on the Blockworks channel. And we just want to thank Blockworks for being the home for, I think we did about 20 episodes with Blockworks. So almost half a year. And Captain Jack has been spectacular. We're going to desperately miss Captain Jack. But I guess our run with Blockworks has come to an end. But we've had nothing but joy working with Blockworks, and it's been a great experience. And especially, the comment section, Booty Crew has just been fantastic, especially, over the last several episodes, including the life of us on this channel. Corey, I'll transition to you because, like I said, I just ramble. You're much more eloquent.
Man, really just throw me under the bus here. No, I don't have a lot to add. This has been a fantastic experience for Jason and myself, and nothing but gratitude towards Blockworks. And thank you, Jack, for all the effort you put into the show. Thank you, everyone who's showed up every week, listening live or listening after. We really appreciate it. Jason and I are not disappearing. We will be back with Pirates of Finance on some other place, some other time, but to be seen.
Speak for yourself. I'm disappearing. Oh man, Brendan, you're right. I think we ran out of time on return stacking again.
Maybe we'll get episode.
That on the next episode. But we hope, thanks for everybody for joining live. Thank you for all your comments as always. It's always entertaining to read the comment, try not to be distracted. I hope everybody in America has a great 4th of July weekend, and more importantly, a safe 4th of July weekend. Mine should be fascinating to watch. But other than that, just thanks again to Captain Jack. He's always keeping us on track. And Corey, you were laughing about something. You got to comment.
No, I was just laughing about the return stacking thing.
One of these days. Guys, thank you so much. I have really been fans of both of you, like as investors, as analysts, in your thought process. It's especially in the world I do, there's a lot of kind of narratives, and I like how both of you really get to the heart of the matter. So when I learned that, Blockworks had a chance of hosting you guys for a little bit, I was really excited, and I'm proud of what we've done. I think that we've had a good time, and I think the audience, if they really pay attention, would learn a lot from what you guys do. And I've seen your Pirates of Finance that you do that was pre-recorded beforehand, and if that ever airs, if that season 2 of that ever airs, which definitely people should check out, like the Pirates of Finance YouTube channel, which is not this, they should. I'll be watching that for sure.
Well,
Jack, you were the one that pushed first to come.
Jack.
Yeah. Now that Jack said that, Corey and I are going to spend the next month figuring out how to SPAC our podcast. But Jack, you were actually the one that pushed for us to come to Blockworks, so it's all thanks to you. And I can't believe we've known each other for years now through multiple iterations of companies and forums. So, man, it's been a long time, man. The time flies. But thanks again to Jack. Thanks again to Blockworks. He's Corey Hoffstein. I'm Jason Buck. He's Captain Jack Farley. Thanks everybody. Have a great 4th of July weekend.
Cheers.